Okay, so today's lecture is on investment policy statements, which are covered in Chapter 4 of the Strong textbook. So let's start off by defining what an investment policy statement is. So first of all, this phrase, investment policy, that is a statement about the long-term objectives, risk tolerance, and constraints faced by a portfolio, and the policy statement will serve as a guide for the managers of the portfolio. It's important to understand that investment policy is completely different from investment management, which is the day-to-day running of the portfolio, buying and selling securities and so on. So the investment policy statement simply describes the policy by which the portfolio should be managed. Managers are responsible for carrying out this policy and meeting the objectives of the portfolio within the constraints that are specified in the investment policy statement. So the investment policy statement is simply a document that says, thou shalt manage the portfolio in accordance with what we say here. All right, so what should be in this document? Well, it should include, first of all, a definition of the beneficiaries. So the beneficiaries are the people, as we'll see, who expect to benefit from the portfolio. It should lay out the expectations and responsibilities, typically of the manager. It should define the portfolio objectives, which we talked about back in Chapter 3, and this should include any required returns and risk tolerance. The portfolio constraints, so for example, there may be liquidity constraints. We'll see an example of that here tonight when we look at an investment policy statement. So it may be that this money needs to be available on a moment's notice, and therefore it's going to be restricted to only very liquid securities, such as treasury bills, for example. The other constraints could include time horizons, legal constraints, taxes, and any unique circumstances. The IPS should define the eligible asset classes and constraints on them, and a mechanism for periodic evaluation. So it may say that the manager should be evaluated semi-annually or annually or quarterly or whatever the time frame is. Now, clearly, from what we've just said, the investment policy statement has to be customized for each investor. You can't have one investment policy statement that covers all possible portfolios. So let's talk about the beneficiaries, who they are. So the beneficiaries are those who expect to receive a benefit from the portfolio. This is not necessarily the same as the owner of the portfolio. So if you're managing your own money, let's say in a taxable account or a 401k or an IRA or whatever, well, you're the owner and probably you are the beneficiary as well. But that's not always the case. There can be more than one beneficiary. So a retirement account typically serves the needs of one investor, maybe a couple instead of just one person, but one investor. But a pension fund serves both current retirees and potential future retirees. And there could be a lot of them, perhaps hundreds of thousands. A trust fund may be set up to serve a group of beneficiaries, and they may all have different goals. And so the investment policy statement is going to have to somehow deal with that. And as I said, note that the beneficiaries do not necessarily own the portfolio. For example, with a charitable fund, let's say that we create a charity called Feed the Hungry. Well, those hungry people don't own the portfolio. They simply benefit from it. With a pension fund, the retirees or potential future retirees don't own the fund. They contribute to it typically, but they don't own it. They don't have a say in how the portfolio is managed on a day-to-day basis. So by defining who the beneficiaries are, that will help us to determine the investment policy. Now, the owner is responsible for defining the investment policy. The owner of the portfolio is the one that says, here is how the portfolio should be managed and who it should be managed for. But the beneficiaries and the managers do not define the investment policy. In fact, beneficiaries should have no say at all in most cases. And the managers, they may have some input, but they don't set the investment policy. They simply carry it out. So, as I said, often the owner of the portfolio has no experience in these things, and they may need some help defining the investment policy. So if you go to a financial planner, for example, they may very well help you to write the investment policy. They'll give you some input, but it's ultimately the owner's decision not the managers. The client, which is typically the owner, is responsible for evaluating the manager on a periodic basis. So if you hire a financial planner, every so often you should have a meeting with that planner, and that is going to be when you evaluate the manager, and you may decide to leave your money with that manager or move to a different planner. Same with a registered investment advisor and so on. The manager is responsible for periodic reporting to the client. Typically this would be monthly or quarterly, but it could be on any schedule that is stated in the investment policy statement. Now, every investment policy statement is going to have a section on objectives and also constraints. So the objectives must be well-defined, clearly stated, and realistic. It's no good to put in your investment policy statement that you want to earn 100% per year. That's unrealistic. It's not going to happen. The objectives should include expectations regarding returns. Again, they need to be realistic, but you might say, I expect the portfolio to earn between 5 and 10% per year, and this will be based on the needs of the beneficiaries. Cash flow needs, similar to return expectations, but here we would specify the size of the cash flows and the timing. The risk tolerance. So the willingness versus the ability to take on risk. So sometimes you have people who are willing to take on a lot of risk, but if you take on a lot of risk, they may not have the ability to bear the consequences when that risk goes against them. So you have to consider willingness and ability. Similarly, the constraints also need to be well defined and realistic. So they should include things like the time horizon. So it should specify that this portfolio is being set up to meet retirement needs 20 years in the future or whatever it is, or maybe it's set up to meet needs that are going to occur in 3 to 5 years. There should be some asset class constraints. For example, you might say we will have no more than 70% of the portfolio invested in common stocks. And then you might further constrain the common stock investments so that it specifies the countries in which those common stocks will trade. So you might say 50% will be US-based stocks and 50% will be outside of the United States, or whatever the constraints happen to be. Liquidity constraints. So if you need to convert this portfolio into cash quickly, then you're going to have a large allocation probably to highly liquid securities. Now, notice that some of the constraints may affect the objectives. So if you need a lot of liquidity, you're probably not going to be able to earn super high returns. So you have to consider things like that. There may be legal considerations. So some types of investors may have legal constraints that they face. So they may not be able to invest, for example, in common stocks. There may be tax considerations, and there could be unique circumstances for different investors. Now, we just talked a little bit about constraints and specifically asset class constraints, but understand that the investment policy statement should define the allowable asset classes and their maximum weights. Sometimes you might see an investment policy statement that says the portfolio will be invested 60% in stocks and 40% in bonds. That's probably not ideal because the prices of bonds and stocks change constantly, and so you're going to be in constant violation of that kind of a constraint. Probably better to specify a range of values. So you might say we should have between 50 and 70% invested in stocks with the balance invested in bonds, something like that. And obviously the asset classes will be determined by the objectives and the beneficiary's risk tolerance. Constraints, limitations on credit ratings and maturities. We'll see that here in a little bit. There can be limitations on the maximum exposure to individual investors. So a policy may say you cannot invest more than 5% of the portfolio with securities issued by any one investor, or you can't have more than 10% of the portfolio invested in any one industry, and similar kinds of things. There may be securities that are specifically excluded from consideration. So, for instance, the policy may say you cannot invest in futures contracts or leveraged ETFs or anything like that. Now, there may be times when constraints need to be violated. So, for example, if the portfolio has a big position in AAA rated bonds and there's a credit downgrade, well, you may not be able to sell those securities immediately, even if the policy states you can't own anything less than AAA bonds. So there needs to be something in the policy that specifies how constraint violations are dealt with. Now, the investment policy should outline the exact procedures by which managers will be evaluated. It's no fair to evaluate somebody on criteria that they are not aware of. And that's the same when it comes to managing a portfolio. So the portfolio manager needs to know by what criteria they will be evaluated. So this may be things like what was done. Did they follow the policy? How did they perform? And note that performance should be measured against some well-defined benchmark or possibly an absolute return standard. But either way, the performance ideally should be risk adjusted. Now, speaking about benchmarks, a benchmark is simply a standard against which something else is judged. So a benchmark portfolio typically would be some kind of an index. For example, the S&P 500 or the Russell 2000. Note that the benchmark needs to be appropriate for the investment policy. So if the policy states that the portfolio should be managed such that it invests only in small cap stocks, well, then it's not appropriate to have the benchmark be the S&P 500 because that's large cap stocks. Now, the benchmark has to be, first of all, investable. In other words, the client, the owner of the portfolio, should have a choice to either purchase the benchmark or invest with the manager. The only reason to invest with a manager instead of buying the benchmark is because you believe that the manager may be able to outperform the benchmark. But as we'll see later in the semester, that's typically not the case. It should also be specified in advance. I used to have a student that worked for Lipper Analytical in downtown Denver, and a part of his job was determining which benchmarks would be used for specific mutual funds. And every single month, he would get calls from mutual fund managers trying to get their benchmark changed to some benchmark portfolio that they had beaten regularly in the past, instead of the one that Lipper thought was appropriate for the portfolio. It's no fair changing the rules in the middle of the game. And so the benchmark has to be specified in advance. And the benchmark needs to be unambiguous. So it should ideally specify some combination of asset classes or indices or whatever. Once in a while, the investment policy statement needs to be revised, and the policy statement should specify how often that's allowable and how it should be done. So there could be substantial changes in the circumstances or objectives of the owner of the portfolio. That would be legitimate. You should never change the policy just to take advantage of some short-term investment opportunity. So, this month I feel like stocks are overvalued, but we're already at our minimum allocation to stocks, therefore I'm going to lower that. You can't do that. The investment policy has to have some permanence to it. Otherwise, it's no good. That's just a quick outline of what should be in an investment policy statement. Next, I'm going to take a look at an actual investment policy statement. Actually, a couple of them. And then that will be it for this week. So keep in mind that I think it's important that you read Chapter 4 in the Strong book and get an understanding of these. But there's not really a whole lot that I can add to that. And that's why we have such a short lecture this week. All right, so let's take a look at the investment policy statement of the city of Carlsbad, which is a city in California. Okay, what I have here is the investment policy statement for the city of Carlsbad, which is located in California. And this is one that I found on the internet some years ago. And I think it's a good one. And I went through and I highlighted parts of it. I also have a more up-to-date version of this same investment policy statement that's available on Canvas, as well as a few others. But let's take a look at this one. And also note that in the appendix to Chapter 4 of your textbook, there are a couple of additional investment policy statements in there that you might want to take a quick look at. So we start off with a table of contents, and then we get into the investment policy statement. Now notice it starts off and it says the purpose of this document is to identify various policies and procedures that enhance opportunities for a prudent and systematic investment policy and to organize and formalize investment-related activities. Here's the point. The city receives tax revenue, and that tax revenue is not all spent at once, and so they have some investable funds that are available. And the purpose of this document is to specify how those funds are to be invested. So in Section 2, it says that it is the policy of the City of Carlsbad to invest public funds not required for immediate day-to-day operations in safe and liquid investments having an acceptable return while conforming to all state statutes and the city's investment policy governing the investment of public funds. Then they talk a little bit about the scope, pooled investments, investments held separately. Then we get into objectives. And the objectives in this order are, number one, safety. And they say safety of principal is the foremost objective of the investment program. They cannot afford to lose even a penny of taxpayer money. And so safety is the number one consideration. Number two is liquidity. And they say the city's investment portfolio will remain sufficiently liquid to enable the city to meet all operating requirements which might reasonably be anticipated. And then the last thing that they're concerned about is the return that they earn. As long as it's at least zero, they're going to be happy. Obviously, the higher it is, the better, but that's the last consideration. They say investment return becomes a consideration only after the basic requirements of safety and liquidity have been met. Then it goes on to say the city treasurer shall strive to maintain the level of investment of all contingency reserves and inactive funds as close to 100% as possible. In other words, they don't want to have cash sitting around earning nothing. Next, they outline the duties and responsibilities. So basically, this says that the management of the cash is the responsibility of the treasurer as directed by the city council, etc. Notice that Section 6 talks about prudence, and they say, as a trustee, the standard of prudence to be used shall be the prudent investor standard and shall be applied in the context of managing the overall portfolio. We talked about this in the last chapter, the Uniform Prudent Investor Act of 1992. That's exactly what they're referring to here. Notice they say in the context of managing the overall portfolio. So it's not so much the individual securities, although that's important, but they're looking at the portfolio as a whole. Now in Section 8, they define the authorized investments. And notice that these are going to be all very safe and highly liquid types of investments. So first they say obligations of the U.S. government, its agencies, and instrumentalities. So here they're talking about treasury bills, maybe some notes and bonds, some agency debt, and so on. Bankers' acceptances that are eligible for purchase by the Federal Reserve System. So bankers' acceptance, if you're not familiar with these, this is essentially a document that arises typically in the course of trade, particularly international trade. And the idea is that maybe I own a company and I receive an order from somebody overseas that I do not know. Therefore, I don't trust them to necessarily pay when I bill them. So they get a letter of credit from their bank, and they send that to my bank. My bank stamps it as accepted, meaning that they guarantee that they will pay it. So my bank is guaranteeing that they will pay it. That guarantee then can be sold on the open market to generate cash immediately. That's a banker's acceptance. And it's typically a fairly short-term document, less than a year to maturity. Time certificates of deposit. These are CDs that should not exceed 1 year to maturity. Negotiable CDs issued by nationally or state chartered bank. And notice that they say purchases of these cannot exceed 30% of the portfolio. Prime commercial paper. Commercial paper is very much like, say, a treasury bill, but it's issued by a high-quality company. Generally, the companies that issue commercial paper are very highly rated. That is, they have unquestioned credit quality. They say that commercial paper cannot represent more than 10% of the outstanding paper of an issuing corporation. So in other words, you don't want to buy it all. Repurchase agreements with a maximum maturity of 1 week. A repurchase agreement is not so much a security as it is a method of funding. So maybe the city of Carlsbad has some treasury bills that they own, but they need some cash. So what they might do then is enter into a repurchase agreement by which they will use the treasuries as collateral for a short-term loan. And these repurchase agreements very often are overnight arrangements, or they could be very short-term arrangements. They're typically not long-term arrangements. Medium-term corporate notes with a maximum of 5 years to maturity. Those cannot exceed 30% of the portfolio. Money market funds. Sweep account for the investment of overnight funds when funds are swept into investments allowed by the policy. So when you have cash sitting in your brokerage account, typically that would be swept into, say, a money market fund so that you're not going without earning interest on that money. And then finally, there's the local agency investment fund of the state of California, so money can be placed in that. Note that they say investments will be made only in readily marketable securities actively traded in the secondary market. This is to ensure liquidity. In other words, if they need cash immediately, they can sell their investments and get that cash. In Section 10, and specifically 10.1, they say no investment will be made that either has an embedded option or a characteristic which could seriously limit accrual rates or which could result in zero accrual periods. What they don't want here are leveraged investments. Remember, this is supposed to be very safe, and that's what Section 10.2 specifies. Section 11 talks about their investment strategy, and basically it says a buy and hold strategy will generally be followed. That is, once the investments are made, they'll be held until maturity. So they're not trading on a regular basis. Section 12 talks about diversification, and specifically it says the portfolio will be diversified to avoid incurring unreasonable and avoidable risks regarding specific security types or individual financial institutions. With the exception of the U.S. Treasury/federal agency securities and authorized pools, no more than 5% of the portfolio will be placed with any single issuer. So we talked about constraints earlier like that. Now, Section 13, modified duration, is a term that's used when talking about investing in fixed income securities. Generally, for our purposes right now, you can think of this as the term of the investment, although it also involves not only term to maturity, but also the yield and the coupon rate. But they say investments maturing within 1 year must be at least equal to the approved operating budget of the current year. In other words, they want to make sure that their short-term securities are enough to fund the city for an entire year. They say that the average portfolio investment maturity shall be 3 years or less. And then they say investments beyond 5 years will not be greater than 10% of the portfolio and will be counted in the percentage of the portfolio that mature beyond 1 year. No investments will be made that mature beyond 10 years from the current date. In other words, they want to keep this very short term. That's both for safety as well as liquidity reasons. And then they get a little bit more specific when they talk about modified duration. They say to ensure that this is the case, a maximum modified duration is established at 2.2. So really, what that means is probably at most 3, 4, 5 year term to maturity. In Section 14, they talk about selecting financial institutions and brokers and dealers, and they simply say investments shall be purchased only through well-established financially sound institutions. What they don't want is to make investments with some firm that was set up by a friend of the treasurer yesterday and so on. They want to make sure that they have somebody that they can go after if things go wrong. Now, Section 18 talks about reporting requirements, and they say that the investment report shall be submitted monthly by the treasurer within 30 days following the end of the month covered by the report, and that this report should include an itemized listing of the portfolio investments by type, date of maturity, yield to maturity, and issuer, the par value of each, credit ratings of each, the accrued income, weighted average yield of the portfolio, weighted average days to maturity, and so on. So they get into some detail about what must be in the performance report that's submitted monthly. And then finally, in Section 23, they talk about the adoption of the policy. So they basically say that section whatever of the California Government Code requires the city treasurer to render to the city council and the investment review committee a statement of investment policy no less frequently than once each year. And then finally, they end with a glossary of terms. One more investment policy statement that I want to look at may be of interest, particularly if you're taking Mr. Shore's class where you're investing university money. So what I have is the investment policy statement from CSU. Now this is kind of an old one. It's probably been changed since then, but I wanted to take a look at that. Okay, so what you see here is a short investment policy statement from the Summit Fund, which is the student-managed investment fund at CSU. And I'm not going to go through this in any kind of detail, but I just want to show you that really any kind of portfolio should have an investment policy statement, and that includes student-managed funds. So they talk a little bit about the background of the fund, how it was initially created. There was a $50,000 donation in 1999, and as of 2009, it had about $140,000 in it. Then they talk about the goals and objectives, and in particular what you should note here is it says this fund has educational goals and objectives as well as investment objective. The educational goal is to enrich the educational experience by bridging academic coursework with professional experience in managing an actual fund. And then down at the bottom, they say the strategic asset allocation is derived by combining the constraints below with the investment objectives as derived from. Basically, what they're going to say here is that they want to have virtually all of the portfolio invested in stocks. Now, they talk a little bit about risk tolerance, a return objective. Note here that they say based on the strategic asset allocation, the fund seeks a return of approximately 8.5% per year. That seems pretty high, but remember that they're going to be invested almost entirely in stocks. The rest would be cash. So maybe that's not such a bad thing. Constraints, they have a time horizon of longer than 5 years. They say as far as liquidity goes that they have moderate liquidity requirements. In other words, they don't need the cash from this portfolio for any ongoing operating needs. Taxes, there are no taxes for a student-managed fund, so they don't need to be concerned with that. Legal and regulatory, there are no legal or regulatory constraints, and they have no unique constraints. Then they talk a little bit about the strategy of the fund, and then the execution of the investment policy. And then finally, they mention feedback and evaluation. And here they say the student portfolio managers will monitor the performance of the fund weekly at meetings during the academic year. They will use several analytical tools to monitor the portfolio. And then at the conclusion of each calendar year, the student portfolio managers will prepare a performance report, including an evaluation of the fund performance relative to the blended benchmark. And they talk about some risk-adjusted performance measures that they will use, as well as an overall overview of the financial markets and a review of the holdings in each sector. This has been just a quick review of a couple of different investment policy statements. What I want you to be familiar with are the broad outlines of what I talked about in the lecture. Basically, what an investment policy statement is, who the beneficiaries might be, an idea about constraints and objectives, and so on. And so by reviewing a couple of these investment policy statements, you'll kind of get a feel for that. But make sure that you read through Chapter 4. As I said earlier, I really can't add a whole lot to that. So it's important that you read the chapter. All right, I'll see you next week when we'll talk about calculating rates of return.